The power of
How you do?
volatility. This is a segment written by our research team, The Power of Volatility. So, in the realm of trading, the practice involves skillfully navigating trades with different implied volatility environments, a crucial metric in option trading that gauges market expectations for future price changes. We call this context. When making trading decisions, it's crucial to consider both the potential for maximizing profits and the annual return on capital, as well as identifying opportunities for risk mitigation. Therefore, this study aims to revisit and explore the impact of volatility and IVR environments on risk, reward, buying power, annual return on capital, and the other historical performance metrics. This is what we call heavy stuff. Get your helmet on, bat. Get your mitt. Get your ball. Okay, you're a little off your game today. Get your act together. Okay, here we go.
Okay, sure.
Study 20 years worth of data. This is a massive study that we put together. We're going to sell 16 Delta Strangles to the spies, and we're going to manage it 21 days. We're going to compute the historical performance, all the stuff I just talked about, the buying power, return on capital, and we're going to compare in high and low IV environments. This is just a more confirmation of a lot of stuff that we already do. It's called the power of volatility. This table showcases how P&L, the largest profit, buying power, the win rate, and the annual return on capital behave when IVR is below or above 30 respectively. So as the IVR increases, also does the P&L and the largest profit, the win rate, the annual return on capital, but the buying power actually decreases. You understand that, right? IVR below 30 and above 30. We have them both here. The first thing and the most important thing, the reason that we segregate by IVR is just because if you're going to take X amount of risk, like why would you take X amount of risk to make $21?
Same reward. You wouldn't want to. You want to make more.
In this case, the perfect example is 20 years of data. Why do something where the risk reward is marginal, but it's double when it's a little bit higher? Like you just have to wait. You pick your spot. So the win rate is higher when IVR is higher. And I was going to say that that's probably going to be about equal, but the profits are 2.5 times. The buying power is actually lower. And this is the crazy thing. The buying power goes down when the IVR goes up. This is not like span margining where the buying power actually goes up when volatility goes higher. In this case, the buying power goes slightly lower because the premium you're collecting is greater. So it's reducing the amount of money that you have to put up. So the annual return on capital becomes a completely different number on a percentage basis. I know it sounds crazy, but again, most people don't recognize this with listed options. It's one of the kind of the weird things that we learned when we started doing all the research that we do.
Nuances. No, if it's not weird, it's not like something that you take advantage of. It is what it is. I mean, you're going to have a larger expected move. You're going further out. It's usually less buying power. It's a good thing.
Yes. The main takeaway from this first slide is that the final P&L when IVR is below 30 is $21. The final P&L when IVR is above 30 is $48. That's 2.5 times. Also, The win rates assume they're close enough, but the buying power used is 25% less. And the annual return on capital is 3x.
Those are all positives.
Yeah, those are all positive for IVR. So with IVR below 30, the P&L, largest profit, buying power, win rate, annual return on capital decreased due to the limited trading opportunities in low implied volatility. And the buying power increases requiring less capital for risk management. On the flip side, with the IVR above 30, P&L, largest profit, BP, the win rate, and the annual return on capital tend to rise due to higher profit potential in volatile markets. However, the buying power often drops as more capital is needed to handle the increased. So let's take a look when we also consider the risk and the win rate and how they behave when IVR is above and below 30. We found that risk, because it's a little bit different, CVAR, worst loss, standard deviation, decrease as IVR increases, while the win rate remains pretty much the same. So the win rate, like we said before, was 70-73. But here's the thing. So the worst loss is much worse when IVR is below 30. I mean, we're talking 3,400 to 1,300. It's almost, it's 2.5 times, just like the dollars. The standard deviation, plus and minus, is going to be the same. The win rate's virtually the same. The CVAR's virtually the same, even a little bit lower when IVR is higher. And the annual return on capital, as we talked about before, is significantly better. The takeaway here is your worst loss is so much worse when IVR is low. 5% of all your cases is 20% better. So we're in a really good shape here with high IVR. On the contrary, when implied volatility is high and the market expects significant price fluctuations, the inherent risk linked to the trade might be comparatively lower. So this is because the trade has the potential to gain from more substantial and potentially rewarding price movements, also leading to an increase in the annual return on capital, all just making the same case, but really well said. So the takeaways. In the context of volatility, our study demonstrates that selling a trade under the 21-day management window tends to yield more advantages in high IVR settings as opposed to low. I think we've known that, but we just showed you a bunch of different ways. The study suggests that in the past 20 years, in high IVR environments, there were notable increase of 3.5 times in annual return on capital, twofold increase in the final P&L, and a 34% increase in the largest profit. However, the risk, CVAR, reduces relatively by 19%, which is crazy. Less risk, make more money. The worst loss reduces by 63%. Again, make more money, take less risk. And the standard deviation is 3.5%, and the buying power decreases by 21%. These are all really strong arguments for high IVR.